And we're live. Iman, I think we've had a bit of feedback in a few of the recent episodes. People said there has been maybe a bit too much banter and a bit too much authenticity, but hey, authentic content creation, here you go.
I was going to rip you for your haircut, for your new haircut, but you know what? I'm going to take a leaf out of your book that you just said and just take a step back. And
well, talking of fresh haircuts, our guest today is no stranger. Yesterday, actually, it's been a bit of a journey to get him on because he's been on a ride for the past 9-10 months. Our guest is Samir Kaji. If you are in this space, unless you've been living under a rock, you would have probably heard of him. If you are not from this space, then a quick introduction is that me and Samir, I suppose, have two things in common. One is that we've both previously worked at SVB, Silicon Valley Bank, and the other is that we both publish content online. But the big difference is that in both of those, he has way more experience than I do and a lot more success. So he started his career in the late 90s, in the dot-com boom at SVB as an analyst. He worked from analyst position all the way up to managing director in Menlo Park, Santa Clara, basically and Palo Alto offices in the heart of it, up until 2012, where he went to First Republic Bank, where he spent the next 9 years. And last December, when he was still at First Republic, we were in communication with him. We said, Samir, let's get you on the pod. We were working out timings, and I think it was around February where he left. And then he said, give me some time, I'm setting something up. Then they were in stealth, I think. Then they announced Allocate, his company, which we're going to discuss a lot about today. And after Allocate launched, we saw the fundraising announcement a couple of months ago. But finally, 10 months later, here we are, CEO and founder of Allocate, host of the Venture Unlocked podcast, publishes an exceptional OG blog in the Valley at pevcbanker.com, and a fellow of Kaufman Fellows Class 20. Samir Kaji, welcome to the show.
Well, guys, thanks for having me on. And that was, I should bring you on the road shows. I mean, that was an amazing introduction and probably well above what I actually deserve. But thanks for being on, and sorry for the long delay in getting here.
It's all good. It's the Persian bazaar salesman within me. So when it's a roadshow time, just let me know. So we don't like to spend too long on the background. We want to get through a lot of stuff. But if you give us a quick high-level overview of just your background, because correct me if I'm wrong, I read a tweet from you a while back which said you kind of stumbled into the SVB analyst position, yet where you've come and how far you've come and the passion you've developed is tremendous. And it's what I tell young people a lot of the time, which is they overthink and try and optimize their career decisions, whereas you just stumbled into it. And I always say you develop passion by getting good at something. So what was the story there? You just stumbled into it?
It's exactly that. So in 1999, I was looking for a job. I was actually selling vacuum cleaners at Sears, which is a department store here, no longer actually functioning. And, I figured I got my degree. I better get actually a real job like an adult. And I went on the job board of my university. And as I was looking at it, on the very top, it said Silicon Valley Bank, analyst position in the venture capital group. And I, said, okay, well, let's just try this. That was a Wednesday. 99 was when a lot of people were hiring. This is the height of the dot-com boom. And ultimately, I had the interview 2 days later. They hired me on Monday, not because I was this incredible orator of my background and I had a great sense of what I wanted to do, but rather because they needed people. And so I joined. Immediately, I fell in love with the industry. I thought, all these amazing entrepreneurs are creating cool things. What we didn't know at the time was a lot of those companies were actually built on really bad business models. 99, came and went, and in 2000, the bubble burst. And ultimately, I remember thinking, what did I get myself into? Maybe I should have stayed, selling vacuum cleaners. But it was a great time to learn. And I really stayed within the banking sector for the next 22 years.
fast forward all the way to March of this year, March 2021, you announced that after 20 plus years as a VC banker, you were going to take the plunge into entrepreneurship. So walk us through the story of how you went from, I've completed banking, I've completed VC banking, into entering the entrepreneurship space.
Just a little bit of background. My father was an entrepreneur in real estate. I sold baseball cards when I was really young. I actually had my own card business. And so the entrepreneurial bug was always in me. And I think I was an uneasy banker and that I also wanted to build a lot of cool stuff. And sometimes you just can't do that within big financial organizations. But what really catalyzed this journey is when I joined FRB in 2012, we had a very clear thesis that we believed that the world of venture was forever changing, away from this monolith where every firm looked the same to being much more decentralized, smaller, more artisanal, sector-focused funds. Obviously, some big ones like the Andreessens, Sequoias of the world. But fundamentally, we just believed that the next era of venture was going to be marked by more funders, funding companies that were investing across many different industries. So when I started my career, as mentioned in '99, venture and tech was still pretty fringe. I mean, there was not a lot of adoption. And, today, of course, it's completely ubiquitous. And so when we were building our practice, throughout that time, we focused on early managers. We wanted to be at the 0 to 1 level with venture fund managers because we believed some of the people that were starting in 2012 and 13 were going to be the best firms of tomorrow within whatever game they were playing. And, our first two clients actually were 8VC and Forerunner Ventures, which today have built fantastic franchises. And our belief was if we could help these managers get off the ground, be it through advice, help with getting in front of LPs, or just help with general infrastructure, that, not only could we bank them, but we could build a lot of long-term great relationships. We built that group to 50 people, almost 800 firms on the platform. But what we realized through that time was, number one, like our theory that venture was going to be decentralized did happen. The second thing that we saw was the private markets became more and more relevant. Amazon went public in '97, 3 years after founding. The average company today, exits, 7 to 12 years, at least the large ones. And you look at companies like Airbnb, Facebook, Roblox, Canva, which today in the private markets is worth $40 billion. And we knew that to be a successful investor investing in the innovation sector, you have to have some exposure to the private markets. You can't just wait till these companies go public. And within that, we just saw the same people benefiting from investing in the best companies and firms, the institutions, the people that were highly networked. And I've always grown up in a world where I just feel like there should be more inclusion. And we looked around and said, there's 11,000 family offices, there's over 17 million accredited investors. Why can't these people invest in the highest quality private alternatives? And so that was the inspiration, and this really started in 2020, of creating Allocate, which is fundamentally allowing people of all sizes that are qualified to be able to participate like institutions, invest in the best firms where Allocate brings discovery, brings diligence, and then provides access at dollar sizes that are far below the minimum check sizes that investors typically have. So that's what we did. We decided to make the plunge, and in January of this year, we actually did it. And actually, today's a pretty interesting day because we actually released our MVP to our first group of investors.
You guys, back in late July, it was announced on TechCrunch that you raised a $5 million round from a group of investors such as Urban Innovation Fund, Tusk Venture Partners, Basis Set Ventures, Fika Ventures, Antemis Group, a whole load of very credible backers. And one question that is always on my mind, because me and Eman have been publishing content, we've now it's measly compared to what you've done, but we've got over 1,000 subscribers on the newsletter, and people like, we've had Ruben Harris on before, who built the Breaking Into Startups podcast, and then off the back of that launched Career Karma. Are we seeing a model where building a distribution list and or social capital online, as you had with the PEVC Banker blog, and now the podcast that you do as well, have these helped in raising so quickly? And as a follow-on question, how do you plan on increasing access or discoverability with early managers? Is it through that distribution list that I've mentioned?
To your first question, I don't know that it helped with the fundraising itself. I mean, those are based on longstanding relationships that we had built with a number of those managers who had seen, I think, consistently the things that we had done for them, maybe at First Republic, or more importantly for the industry. The social, media, I mean, at the end of the day, I started it because I was talking to a lot of smart people every single day. And I felt that if we can get some of those thoughts out in the market, we'd be able to help a lot of fund managers that were starting off. And that was just sort of the basis. I have this, overall passion for writing, and ultimately, speaking and really finding ways to lift the industry. And so it just started with that. I didn't really have any plan. I just put a bunch of crap out there, and over time, people said, "Hey, this is pretty interesting. This is actually helping me." So it just emboldened me to do more of that. Now, in terms of where I see it today, in the fundraise itself, we're in a great environment where fundraising right now, for founders is probably as easy as it's ever been. That said, it was not an easy fundraise. I mean, we actually spent a lot of time and we had to go through a lot of rigor with the different investors. It was good, hygiene for us to do it. And it took a couple months, right? And, we're proud to have those type of investors. But when you think about social, and I also apply it toward fund managers, it is important to have a brand and identity. For me now, it's just my voice. Oftentimes I'll meet somebody for the very first time and they have a pretty good sense of what my ethos is, what my values are, how I think about the world, and they can self-select in or out. And that's really helped me. It's helped the business. And, I think that as long as you're authentic about putting out your posts and you occasionally have something that is really non-consensus, you're going to do very well. I have a lot of non-consensus thoughts. I don't actually believe in a lot of the things that do happen, but I try to be very careful and balanced in terms of what I write.
For those that don't necessarily understand the venture space as well as yourself, can you explain in sort of layman's terms what Allocate is, and then explain kind of how the idea came about, building on what you were explaining in the earlier explanation you were giving?
Yeah. So, I'll give you an example. So at FRB, there's three legs of FRB's business. There's commercial banking, private banking, and private wealth management. And what we found is, in today's world, particularly over the last 10 years, people are now looking to invest in things other than traditional stocks and bonds. In fact, the bond market's been dead, for a very long time. It still has a place in people's asset allocation portfolios, but doesn't need to be 40 or 50%. And so over the last 10 years, we've seen people want to invest in things like alternatives, and that, be it that private equity, private credit, venture capital, startups. Now today it's NFTs, crypto. And we think that the world of alternatives will continue to be a bigger and bigger part of people's portfolios. And, today, we're seeing, the next generation of wealth. And in fact, every single year, $2 to $3 trillion is being transferred from baby boomers to the next generation who have very different investment styles. But we found, investing in private assets that are technology based are really hard because there's 4,000 active US investors. Getting into them is tough, especially the ones that are capacity constrained. Finding them are tough, and manager selection is really tough. And so what we do is we have a platform where, let's say, you are an investor, you're a family office, or you're an individual that works with a wealth advisor. You'd be able to go on the platform, find opportunities in funds, co-invest, or structured funds that we create, like a fund of funds, where you can invest in some of these top tier assets. A fund manager, we've done ones like Sousa Ventures and others, where you can now invest as low as $100,000 and get access to these funds. We do that through, specially created vehicles where we aggregate the commitments and then make a single LP investment into the underlying fund. And for us, we've always been very focused on how do you actually create financial inclusion at scale? How do we allow all these people that have demand and that are qualified the ability to invest in these type of great managers who we have a relationship with? And so we felt really strongly about creating a technology solution, one that makes it easy for the discovery, where all of the interesting areas about that particular fund opportunity are on a screen where you can evaluate. And then we make everything from the subscription agreements to the request for allocations to all the reporting and performance tracking through a single portal.
Samir, shifting gears, I'm really keen to know, what have you learned? What are, let's say, 2 or 3 things you've learned from 20 plus years of literally being in the heart of the world's innovation hub? Because that's where you've been located.
I think the main thing is, number one, never bet against innovation. I know the capitalization markets are what they are, and it's hard to debate that there isn't overvaluation at every stage in probably every region. However, you have to look at the tailwinds of innovation. And if you think about areas, whether it be fintech, robotics, synthetic biology, we're in the early days of long-term adoption. In fact, we're in the current version of the Industrial Revolution that is going to last the remainder, at least, of this decade. And therefore, I'm very bullish about it. I've always spent too much time looking at market cycles and less time focused on what is actually happening. And so, number one, it's never bet against innovation. The second thing is know that it's going to constantly evolve. The last 10 years have seen more evolution of the venture market than we've ever seen before. Now there's the advent of rolling funds, sector-focused funds. We've seen this barbell of the venture market where you have big aircraft carriers like Andreessen that are effectively capital providers for companies that just happen to be in tech. But the risk profile for a lot of those firms is no different than private equity. And at the early stage of the market, you're starting to see even studio models and others continue to evolve. So we will see major evolution in the market. And any point in time, you can never take a static view of what's happening and say that right now it's overvalued, tomorrow it's not. We don't know where the markets are going to go, but we do know that the technology markets are going to evolve at a pace that we've never seen before.
Very similar to the message that Cathie Wood puts out there, right? Which is fundamentally, let's not think about short-term horizons around returns particularly. Let's think about what technology creates and provides over the longer period and what that impact looks like in terms of today's metrics and measurements, but also the longer term changes to those metrics and measurements, i.e. her view is potentially that we're in a deflationary period if you look at technology specifically. Now, I want to kind of pick on that a little bit, which is around your angel investments. So this is where I think your entrepreneurial hat, your venture banking hat, they all kind of come together, and it's proof of work in a sense. From our very short research, it seems that you have 7 exits from 27 investments, according to AngelList, which is obviously amazing. Anyone that knows anything about angel investing will know how difficult it is. How do you assess these investments, particularly from a first principles perspective? What advice can you give that shows that you're picking these 7, not by luck, not by chance, but a lot by your principles?
It's a great question and probably involves multiple vectors. So first of all, having 7 exits out of 27, there's always an element of luck here. And a lot of what happens from a return perspective can be arbitrary. What you try to do is create process that increases the probability of great returns, meaning that you pick companies that have a chance of producing these exits that everyone's looking for. You don't know what's going to happen, though. I mean, I could have invested in 27 companies and had 0 exits, as well as I've had 7. So one thing just to mention is I typically do invest at the seed stage. I love that 0 to 1 stage for founders. I love talking to them about their visions. And what you're really investing on is not necessarily things like, I don't look at things like TAM too heavily. I mean, I do look at it, but at the end of the day, what I know the business model's changed, and I know the market's changed so dramatically. If you had looked at TAM, for example, for Uber and Lyft in the early days, you would have said the TAM's not there. Who wants to do this? Airbnb the same way. But fundamentally, we look at the founder. Are they passionate about what they're doing? Do they have conviction in a vision that's well articulated? And number 3, are they just absolutely neurotic about solving this issue? And do I believe they'll figure it out? Because I'd say almost with every single investment I've made, the original idea was not the idea that ultimately drove them to scale. And so, for us, it's just sitting in front of somebody and saying, do I trust this person as a fiduciary of my capital? And do I understand the space? Like I like to invest in things that I understand. I like to invest in things that excite me. So I've passed on deals where they've actually turned out to be pretty good, but it just didn't excite me. I didn't really understand it. And that's okay. Like I don't need to invest in every company. I'm not going to hit every great company. But fortunately, I was in a place where I had relationships that would lead me into the right room of seeing the founders more often, the good founders more often than not. and then assessing those. But, to me, it was very, very founder driven, almost in every single great company that I invested in.
There is a rise clearly in the markets the past few years, especially in the past year, of solo GPs. And as we discussed, people who leverage the social capital they've built and the brand they've built. And as a result, this category of emerging managers as well. Something I want to go a bit deeper on is how you determine what a good emerging manager looks like. You have a tweet from, it was last December actually, where you said that you're not a big fan of the question that LPs often ask, is the GP differentiated? And you said the question is really whether that GP has some definable edge that 1 matters, 2 is clear, 3 is sustainable, and 4 is authentic. So if you can maybe just give us go a bit deeper on that, and generally what should LPs be looking for in a good emerging manager?
So good question. And I'll look at, first of all, how difficult the LP job is today. I mean, in the past, and this is like 15 years ago, since every firm competed in the same arena, generally speaking, certainly in 2005, you could look at a list of them and said, who are the top 10 or 15% of the managers? Who's the Greylocks and Sequoias and Excels? And if you can't get in those managers, there's no point in actually investing. The world has changed because now there's so many subsectors within the industry, and therefore a firm like an Initialize, which raised, I think, less than 10 million for their first fund and had a company called Coinbase in it, can do extraordinarily well. And so you have to think about, how do you get into, some of these managers when there's a chance that as those managers scale and do well, you're not going to be able to invest in a fund 3 or fund 4. And so it is really important to look at these fund 1s and fund 2s. Now, here's the problem. The problem is you don't have a lot of track record, to look back on. And sometimes the track record that they do have is simply just not relevant. It's too early to matter. Or if somebody has a 3x over the last 2 years, I don't really care. I care more about what led to the companies within that track record. How did they find them? How did they win those deals? And so what we look at when we look at emerging managers, candidly, is what is the GP thesis fit? So not necessarily, what is their differentiation more generally, but with the strategy that they're going after. If it's a sector strategy, what's their domain expertise? What is their network? And how do those things factor into the lens of sourcing, winning, and picking? And we go pretty deep on understanding those things. In fact, when we bring a fund onto our platform, we've already done pretty strong diligence on talking to founders, talking to other GPs, talking to even LPs, and saying, does this person have some kind of comparative edge within the thesis they're going after? And I'll get into what I mean by thesis in a second. And number 2, do they have process that makes it replicable? Not just right now, but over a long period of time where it's not a simple arbitrage in the early days. And then, of course, you're looking at when you sit across somebody, if they really understand the fundamentals of fund management, firm management, and whether they have thought about the 5, 10, 15-year view. Now, going back to the point of thesis, we look at thesis as it relates to what are they going after? What is the sector they're going after? Where are they investing at the company stage of development? What are they doing to really build a value add proposition that allows them to win consistently? And then finally, within sort of the thesis comment, how big of checks are they writing? You mentioned solo GPs. A lot of the solo GPs are raising funds that are sub 15 million. You can be a nice collaborative investor, putting in $250 to $500K per company, maybe even less. And in that case, the thesis is centered on a collaborative, maybe sector focused, and just being somewhat helpful in the cap table. And that's why a lot of the solo GPs actually, especially with AngelList rolling funds, actually have full-time jobs, and they do it part-time because they use their power of their brand, social media, their sector expertise, and the fact that they're non-frictional capital. And so we look at all those vectors and decide, do we believe that there's a good team thesis fit right now? And what does this look like 2, 3, 4 funds ahead?
What does good look like for equity raising for raising capital for those founders that are either new to the venture space, new to the seed space, new to the angel space? What does good look like from your perspective?
Yeah, so you're talking about fundraising from the emerging manager standpoint. So, I mean, we did a study. Like the reality is, if you're a sub $30 million fund, in all likelihood, it's unlikely you'll get traditional institutional investors. It's fine to have a conversation, but they're usually fund 2 or fund 3, and so your pool of potential investors in your fund is going to be some aggregation of individuals, family offices, smaller fund of funds that are more boutique in nature, and then of course, I would say some of the venture funds themselves. So we've seen, folks like Lightspeed and Andreessen actually invest in early funds because it's a source of deal flow. The best thing to do, in the early days is look to get either an anchor or a referenceable LP, and that could be, hey, we had somebody like a Mark Andreessen come in for $100 million. Well, those are great signals that you yourself have something that could providing a sourcing edge or a competitive edge somewhere. Fundraising is not easy. I mean, the average fundraise for a fund 1 is still 17 months. It's a grind. People should emotionally get ready for those things, knowing that there's going to be a lot of false starts and perhaps false positives in the early days. I think that from a fundraising standpoint, figure out what your target is, and make sure it's in alignment with what the market reality is. Do a first close at a point where you feel like you've hit minimum viable fund size. Start investing, and then focus less on the dollars that you're raising and what you can actually execute with those dollars in ensuring that you have a longer term path. When you start a venture firm, we're not looking at a 2 to 3 year time frame. You're signing up for a fund that probably is 12 to 14 years plus. And if your plan is to raise multiple funds, which I have a hard time believing anybody that's starting a venture firm only wants to raise one fund, you're looking at a 20 to 30 year career. And so you have to really think for the long term. So always be short term focused, long term greedy. And in the short term, what you're really looking to do is achieve some definable milestones that help you grow. No different than a seed stage company. I mean, when we look at our own company, we are looking at a huge long-term vision of bringing private alternatives in the innovation space to all types of investors at scale. But in the early days, we're focusing on funds, venture funds and co-invest, and we need to hit some identifiable milestones to allow us to then, either raise capital or become profitable so we can then build for the future. And I think emerging managers should always keep that in mind. This is a long-term marathon you're running in.
Yeah, great insights, especially on that it's 12 to 14 years before you see any real results. And we've seen actually recently a few OGs of the industry step down, such as one being Bijan Sabet of Spark Capital, and a few other credible names as well. So it totally makes sense because you have these very long cycles and it's like, okay, do I want to go again and go again? There is a topic of discussion at every dinner table these days around the current state of the market, which is it's a bubble, it's saturated, it's overvalued, it's all coming to an end. And as someone who's been through the dot-com boom and the '08 recession and has had a 20 plus year career in this sector, what do you have as an answer to these people who always bring up this topic of discussion at dinner tables?
Well, I mean, I think first of all, there's no way to I don't have a crystal ball. I don't think anyone has a crystal ball that is, 100% transparent in nature. In fact, many people that have been saying those things said that back in 2016. And I remember sitting around many dinner tables from 2016, 17, 18, 19 that said, we're at the tippity top, everything's going to burst. And it actually looked like that was the case, at the beginning of the pandemic. It didn't happen. So I don't know what the future holds. So instead of focusing on what's going to happen or what might happen, we look at, what do we think is more secular in nature? So, I've talked about innovation. The second thing we think is pretty secular is the size and scale tech companies can become. In the past, getting a company to $1 billion in revenues was almost unheard of because you didn't have that type of adoption and distribution. '06 was AWS, '07 was the iPhone. Today, 5.5 billion people plus have smartphones. And so, you look across industries and there's mass adoption. So I know that assets are probably overvalued. To what degree, I don't know. I don't know if it's 10%, 15%. But we have to always look at the fact that there are going to be companies that today are being done at valuations that feel too high, that are ultimately going to be seen as bargains in the future. Facebook, when it raised at $1 billion valuation, I remember everyone throwing their arms up and saying, how does this company that's a social media company where you just friend people and post photos, how is that worth $1 billion? And of course, at one point, I think it actually peaked at $1 trillion in market cap. So you have to think about these secular things. I do believe that many of these companies that are getting funded will never actually live up to those valuations. But you have to understand the incentives of the people that are giving these valuations. They're, in many cases, providing index type of investment philosophies. If I'm a Tiger or Coatue, Tiger can do 100 of these companies, maybe 70 hit a 0.5 to 1x. But if those 30 companies that they do at a $400 or $500 million valuation, one or two of them turn into the next Canva, turn into the next Discord, turn into the next Airbnb, and where they can put more money in those subsequent rounds and really double and triple down, they're going to do exceptionally well. And so I think the capital markets for technology just have forever shifted. Technology is not on the fringe. And in fact, someday we'll actually drop technology from technology company and just say company. So look, I agree with the fact that, valuations are high. I think that manager selection is more important than ever today. But at the same time, I'm incredibly optimistic, and there are a lot of tailwinds, right? So we've seen what the Fed has done. We've seen fiscal and monetary policy. There are, of course, I don't know if there's a canary in the coal mine right now that says next year things are going to burst. They could, but it'll recover, and technology will be continue to be a great place to invest. And if things go wrong and we have a burst, it's actually a great time to invest. And so selfishly, I actually hope some of those things, because I'd like to see lower valuations so I can invest more capital into funds and companies.
It was a hilarious tweet I saw, I think it was today or yesterday, saying Michael Berry has predicted 12 of the last 2 crashes. So I think it's reflective of the environment we're in, which is everyone wants to predict the crash. No one really wants the crash apart from Samir Kaji, who wants it so he can buy it at a discount. But let me talk to you about a specific theme within venture that seems to be really gaining steam over the last 2 years, which is the kind of democratization element of it. And this is markets in general, right? Not just venture. But within venture, you have AngelList doing a lot of innovation in the space, everything from rolling funds, there's micro funds, there are super angels now emerging. We've obviously got the solo GPs we spoke about. What do you see the future of the market from a venture perspective looking like? And where do these new innovative types of players engage in this new market?
So AngelList has done, since you brought them up, I think they've done a great job, and they've introduced effectively what at the end of the day is making it easier for everyday people to invest in startup companies. And a lot of that was allowed by, for example, the Jobs Act that made it possible for people to invest in these companies that were, accredited investors. And actually the rules for accredited investors continue to evolve. So I think, look, more people are going to invest. I think what we're going to see is the retailization of private alternative assets. We've seen that in private equity. And there's companies like iCapital that I think have done a great job in bringing top tier private equity firms to individuals through wealth advisors. AngelList has done that on a retail side. Republic is another firm that's done a great job on the retailization of these assets. So if you think about the retail influence on the capital markets, particularly the private capital markets, retail people want different ways to invest, and you are going to see platforms like the ones that I mentioned and us find ways to make it easier and more responsible for people to invest. And so I don't know what that looks like. I am excited about certain themes. I'm excited about, as I mentioned, the democratization of assets. I'm excited about new type of funders coming into the market that are focusing on different problems. One in particular is diverse managers. So if you look at people that are either BIPOC or female-led funds, there's a huge opportunity in investing in those type of managers because they tend to see they have different networks often. They tend to invest in problems and founders that are also underrepresented. And by the way, the societal benefit of those is those founders are often solving problems that are not for this 1% echo chamber Silicon Valley, but for broader, societal problems. And they're often employing people that are underrepresented. So I get really, really excited about that. It's still early days, but those are some of the themes that I will see. Again, the retailization and then more diversity within the investing ranks.
A bit of a controversial question, but do you anticipate banks like SVB and First Republic to be in business or to have the magnitude of business that they have now 30 plus years from now, given that software is also democratizing so much of startup financing? So we've seen this unbundling where we have companies such as Brex, Mercury, Ramp, Pipe, and they're each attacking a particular division within these traditional banks. So what is, and I know I appreciate you don't have a crystal ball, but for someone who's been 20 years on the other side and now you're somewhat on this, you've sort of seen everything basically. What do you make of the future of these traditional legacy players?
Banks will have a significant issue if they don't evolve. Now, I don't know what the time horizon is. Is it 5 years, 10 years, 15 years, 20 years? The banks actually benefit from significant regulation because a lot of these upstart companies, it's hard to get a bank charter. When you do, have a partner bank, there are certain regulatory walls that larger banks can benefit from. And so whether it be a, First Republic or Silicon Valley Bank or JP Morgan, over the short term, I think parts of their business atrophy because people go to a Brex or people go to a Mercury Bank or some of these other ones that are much more digital first. But it's going to be a while before we see banks truly feel the pain. But if you were to ask me the question in another way, which is if banks do not significantly adjust their policies and the way they operate for really the next generation and really focus on digital first, are they going to be around in the current form in 30 years? The answer is no. They will die. And it's just a matter of time that will happen. Now, fortunately, I think a lot of the banks understand this and are being quite acquisitive and they're doing things. But there is a lot of technical, cultural debt at these larger organizations that the new age fintechs just don't have. And so I'm actually bullish. I've invested in a lot of fintechs and I think they'll do extraordinarily well. But I do think banks will continue to have a place in the system. The ones that survive for the long term and become long-term viable are the ones that can adjust and really, really transform the way they operate with their clients.
Another interesting dynamic thing that's happening in this market, you're seeing a lot of people, and I think we spoke about this earlier on, or at least Cyrus pointed to it, influencers or people of large influence, people who have a following, are essentially now engaging in the venture market. They're engaging in angel investments, early stage investments, seed, whatever it is. Great example of I think Jake Paul or the Paul brothers from YouTube. What do you think of this? Do you think it's a positive thing? Do you think there are any downsides? And to the extent that it could be somewhat dangerous, what do you think that looks like? Do you see the same problems emerging for them as you would for a typical emerging manager?
No, I mean, I think it's a good thing. I mean, we've seen people do, great things like Ashton Kutcher, of course, from Sound Ventures. He's invested for a long time. And many of them actually bring really unique lenses to the market in terms of understanding areas where they can help portfolio companies that traditional venture investors can't. They should be investing. And so I've always said that, for most people that are wealthy, 10 to 30% of their portfolio should probably be likely in alternatives. And if you're in alternatives, it's hard to say you can build a great alternative portfolio without having any type of venture capital. So it only makes sense that they would leverage their brands to invest with some of the best companies. And from a company perspective, if I have somebody like an Ashton Kutcher or Jay-Z on the cap table, and particularly if I'm a consumer company and Jay-Z sends one tweet about my company, that can have a transformational effect on my brand. And so, yeah, I mean, sure, there's some downsides. If the celebrity does something wrong in the public market or in the market, Do you then, get buried underneath that? Sure. I mean, but that's true for any venture investor. So I think it's great. I think there's going to be more of that. And I've seen the performance of some of the influencers who have invested. There's a rapper, Nas, who I think has made more money angel investing than he did actually as a rapper. And you think about that and say, wow, I mean, he's actually one of the best hip hop artists of all time. He re-energized his entire career and remade himself by being an active investor. So yeah, I think it's a great thing.
That may be the Ben Horowitz pipeline going through to Nas.
Right.
So before we wrap up, I suppose one of the questions I have is, what now for Allocate? You mentioned a product launch. Of course, you did the fundraise 2 months ago. What is the focus now, and what is the next thing you guys are trying to attack? What should people be looking out for, especially if they are LPs or family offices and they want to sign up and use your platform?
In the course of Q4, we're going to slowly release the product to more people. We've actually already done 12 investments with what we would consider really top tier managers. We have a great pipeline of managers that are coming. Ultimately, if you are a qualified investor, so we do require accreditation. If you're an accredited investor, that's a family office, that's a high net worth individual, or just somebody that wants to start building a venture portfolio. We're looking forward to having the release more broadly. Right now, we're heads down in terms of getting great products to the market, working with investors to help educate. Education's a big thing with venture capital. It's very idiosyncratic in nature, and so we spend a lot of time doing that. But right now, I want to build a great product, have great products for investors, and make it exceptionally easy for them to execute and track their transactions. So you'll see a lot from us over the next 6 months, and over the next few years. We really believe that we're in this golden age of innovation. And our job is singular, which is bringing the best private innovation products to market and making it easy for anybody that's qualified to be able to invest.
Fitting message to end our more serious chat, but we like to ask some questions towards the end of our podcast that show more about the individual that we're talking to. You tweeted on December the 5th, 2020, 90s and early 2000s hip-hop, greater than anything that comes out now. It's not really close either. You mentioned Jay-Z and Nas. Who's your favorite hip-hop artist?
Tupac. But it's not even a question. It's just Tupac was somebody that I grew up listening to. I think one of his album, All Eyes on Me, was probably one of the best albums of all time. When he actually passed away, I think it was almost 25 years ago now, it was like this seminal moment for me and my friends, because at that time there was this big East versus West. I was living on the West Coast. And so you had, Biggie on the East Coast and P. Diddy and others. And then on the West Coast, it was Tupac, Dr. Dre. And so Tupac, Dr. Dre, and Snoop were my favorite, but Tupac was by far my favorite hip-hop artist of all time. It continues to be so, this day.
And final question to end on an even more personal note for people to learn more about you. What are some values or principles that you personally live by and that have helped you in work and or in life?
I mean, I think for me, it's just I really value relationships with good people. So integrity, humility is a big thing. I've always said, no matter what success you've done absolutely nothing tomorrow. And our industry is filled with a lot of people with ego. And in today's world, everyone has an ego because everyone feels like they've done exceptional, because everyone has a 40% IRR or they're crushing it. And candidly, I don't give a shit. I mean, are you still the person you were from day one? And, I still look at my early days when I was fresh-faced, coming into this industry after selling vacuum cleaners, not knowing what I was doing. And I really just enjoyed being that same person again, knowing that I haven't done anything for tomorrow and knowing that I have to continually learn. So I gravitate toward those type of people. While my network has fortunately become quite big, it's actually quite small in terms of the people that are part of this inner circle that I want to spend time with, that I'm willing to spend time with, and that I enjoy spending time with. So life is short. Make sure you spend it with people that are congruent with your own values and ethos.
And that's why Iman hangs around with me. So
All eyes on me.
I heard the little sarcastic laugh there. I mean,
it's the British humor. Samir, it's been absolute pleasure. I've really enjoyed this conversation. Next time Iman and I are on the West Coast, we've got to take you for some Persian food to feast. And yeah, I've really enjoyed this. I'm looking forward to seeing everything with Allocate, and we're going to link everything in the description. So yeah, thanks so much for coming on.
well, thanks for having me, and I will take you up on the offer for Persian food. One of my best friends, he's Iranian, and so I've had plenty of Persian food over my years, and so look forward to that. And thanks for having me on.
Thank you.
Awesome.